Good morning, everybody. Thank you all for coming here today. I'm awfully excited about you guys coming for an expert's guide to first-time homebuyers. I want to thank everybody on Facebook, our Facebook friends, for being here today, and all these wonderful people for coming. I've got a wonderful crowd here from the DMV, all over the area, and I want to thank you and let you know that Lafayette Federal Credit Union is your sponsor of this event today, along with Credit Union Title. Credit Union Title is a sub-organization of Lafayette, and we do their closings for them. I want to let you know, and especially the people in Facebook, we're sitting in the new headquarters of Lafayette Federal Credit Union, and the people here can see it's awfully spectacular, I'll tell you. It's a beautiful building on Tower Oaks Boulevard in Rockville, and we're incredibly proud of it, and we're certainly happy to be in it. It's a great working environment. So I want to thank you guys, and I want to ask everybody to understand that we have today wonderful licensed professionals. We have a licensed attorney, licensed loan officers, and licensed real estate agents. We're not professional speakers, so please bear with us. We'll do the best that we can. We only speak when we have to. Also, do me a favor, Facebook people will be able to ask questions, but we're going to have to ask you to hold your questions until we let you know when that time is appropriate so we can keep our schedule going. This morning, you'll hear from me, Stephen Rubin, and you'll also hear from Jermaine Medley. And Jermaine's going to step up next. He is the senior loan officer at Lafayette Federal Credit Union. He's going to teach you all about qualifying for a loan, the things you need to know. You'll hear from him as well on home equity loans. You'll hear from real estate agents about what's important about choosing your buyer's agent. And you'll hear from me all about the closing process. So let me invite Jermaine up here next.
Thank you, Stephen. I don't know about Stephen, but I'm a professional speaker, so I can't speak for him, but no. Thank you guys for coming. We'll get right into some of the objectives when buying a home. So one of the things that we'll teach you guys today is learning how to navigate your way through the home buying process. We'll identify the steps to achieve your goal of home ownership, and we'll understand the loan process and programs when you're buying your house. And then Stephen will hop back in and talk a little bit about being prepared for your settlement. What everybody wants to really know. I think benefits of home ownership. Does anybody have anything that they think benefits of a home ownership? No? It's still early, it's okay. One of the opportunities of owning a home is it'll help you build wealth. And building wealth necessarily is a twofold thing. If you're currently renting right now or living with relatives, that's a good opportunity to build wealth because you can save money. And then you can think about buying your home, how much money you want to put down, that sort of thing. Tax savings. There's a lot of benefits when you file your taxes. One, for being a first-time home buyer, you'll get credits. And then obviously the interest income you'll get. The pride of home ownership. I don't know about you, but I own a home, my wife and I, and it's a very prideful thing. We take a great deal of pride in having our home with our kids and our family, so it's a beautiful thing. The security. You're no longer a tenant. You're not being held to a landlord's rules. You actually own your own home, so you can make your own decisions when it comes to if you want to modify your home or make changes. You don't have to ask your tenant or your landlord to do so. And then the other thing is building credit. Once your mortgage hits your credit report and you're paying your mortgage on time, you'll notice your scores start to skyrocket. What are some of the costs associated with the transaction? Obviously, you'll have your lender or loan fees, credit reporting fee, your appraisal fee, which is required on purchase transactions. You will have to be required to put an earnest money deposit down if you are at the point where you're ratifying a contract. And your down payment. You want to know how much strategically do you want to put down. And I'll get into a little bit about that later in terms of down payment. Closing costs. All purchase transactions or refinance transactions come with closing costs. The good thing about Lafayette is we have options where you could roll closing costs in, and we have some other options we can discuss in terms of closing costs. Points. Points are basically if you want to buy your rate down to get a lower interest rate, that's something that you may want to consider. The other additional costs, your mortgage payment, principal, interest, taxes, and insurance are part of your mortgage payment. Here at Lafayette, we do require that you hold an escrow for the taxes and insurance, just so that they are paid. Mortgage insurance, depending on the product that you select, we will require that you pay separate mortgage insurance. We do have moving expenses. You'll be required to, once you're moving from your rental or living with relatives, it's going to be a cost associated with moving, so you want to take that into consideration. And then that's why it's always good to have an emergency or reserve fund, because a lot of the times when you move, in most cases, you're going to incur unexpected expenses. Homeowners dues. If you're purchasing a condominium or a townhome, you'll be required to pay a HOA fee or a condominium fee. So those are some of the things you want to consider when you're looking to purchase your home. And then repair costs. Again, you're no longer renting, so the maintenance man is not going to come and fix your toilet or any damages that you have in the kitchen. You'll be responsible for that on your own. So it's good to always have a handyman or someone that you know on speed dial that can help you fix those repairs. Loan types. It's always important to figure out the type of loan product that you want when you're selecting a mortgage. Most banks that I hear about and work with, they offer adjustable rate mortgages. It's an interest rate that does adjust periodically, and most of the rate adjustments have rate caps. Lafayette, we have a niche product. It's called our Equity Builder Mortgage. And the good thing about this product is it's not tied to secondary market, Wall Street, or LIBOR. It's solely based on our cost of funds and operating margin. And we can kind of control those things. We offer a 1-1 arm, a 3-3 arm, and a 5-5 arm. And what that means is if you're in a 1-1 arm, you're fixed for the first year. Once that year is up, you'll readjust for a year after. So it will change each year. Not to exceed 1 percentage point at the time of each adjustment, and your rate can't go higher than 6 percentage points above the start rate for the life of the loan. If you're in a 3 or 5 year, your rate cannot go higher than 2 percentage points at the time of each adjustment, and you can't go higher than 5 percentage points above the start rate for the life of the loan. So those are some of the things that you'll need to know when you're considering an ARM, especially with Lafayette. It's completely different from any bank or other credit union, most credit unions. And the good thing about that product, it's 100% financing without PMI. What is PMI? Private mortgage insurance. We do offer interest-only options on our ARM product as well. We do offer fixed rate conventional 30, 20, and 15-year fixed as well, where your payments are constant and they'll never change. Some people are not all that familiar with the ARM, and they'd rather take the safe route and go with the fixed rate. That's fine, we offer it. We also have a good program that we've been running for quite some time now. It's called our first-time homebuyer program, where we will deduct 1/8 of a percentage point off of your interest rate, and you're only required to put 10% down without any mortgage insurance. Most conventional financing, you'll be required to put down 20% to avoid mortgage insurance. Well, we're a little flexible with the first-time home buyers. We also offer lender credits on those programs. You can get up to $1,500 from Lafayette. I'll explain. If you're a first-time home buyer, we'll give you $500 just because you're a first-time home buyer. We'll give you another $500 if you elect to do a direct deposit, an automatic payment for the mortgage each month. A direct deposit from your employer into Lafayette, a minimum of $500. And if you use our good friend Stephen Rubin, we'll give you another $500 for the title company. And then we also have down payment assistance programs, which we can discuss. And we have information now on our website that gives more in-depth detail about the down payment assistance programs. Okay, expenses. This is a big thing that you want to consider when you're looking to buy your first home. How much are your liabilities, and how do they impact your loan approval? Well, I can tell you, if you're outstanding on a lot of your credit cards, you may have a high debt ratio, which underwriters are not happy about. So you want to kind of manage your credit card debt. How much are you spending on a monthly basis? And if it's too high, we can figure out a way to consolidate that stuff here at Lafayette, because we offer consumer loans as well. Student loans. If you have student loans that are showing on credit, we are now required to determine what those payments are going to be if they are in deferment. Before, if they were in deferment, we could just exclude that debt. Now we have to determine what that payment is once it comes out of deferment. So these are something that you need to think about. Monthly expenses. Now you'll be responsible for your electric bill, good old Pepco, gas, water, and insurance for cars and other things of that nature. Child support. It's always good if you're receiving child support and you can prove that you're receiving it for a 3-year period or longer, you can actually use that as income as well. Qualifying for a mortgage. These are probably one of the 2 most important things when it comes to getting approved by an underwriter when it comes to qualifying for a mortgage. What is your gross income? We don't use your net, we'll use your gross income when qualifying for your mortgage. What are your current monthly liabilities, which we've discussed? How much can you afford? What's reasonable and what's your comfort level? Obviously, you don't want to have too much house when you're struggling to make the payments. Extra income. If you have a second job and we can provide that you have had that job for 2 years, we can use that as an additional income as well. Credit reporting. This is always tough because I think about the recent issues with Equifax and credit reporting. I like to say it's more and more obsolete because you can have stuff that drags your score down and it's erroneous, but we can work with you with that stuff as well. But it's important that you have good credit behavior historically and going forward. It just looks good in underwriting. Loan estimates. This is something that every borrower should receive when you make application with Lafayette, or any lender for that matter. You should receive a loan estimate within 3 days. The good thing about Lafayette is once you apply, we take all of our applications through our web portal, you will receive a loan application. And it just discloses all the loan costs that are associated with the transaction, just so you can get an idea and feel for how much it's going to cost for this transaction. The loan estimate also will provide the interest rate, and if you've selected to make a decision to buy the rate down by paying points. It also will help you compare if you're shopping around with different lenders, because most people do. And just keep in mind that it's only an estimate. So once you see those fees come out, don't necessarily think that they're set in stone. This is just an estimate to give you an idea of what you're going to pay for. All right, so at this time, I'm going to transfer this over to Stephen Rubin, and he'll talk about some of the common terms, and you'll hear it during the transaction.
Thank you, Jermaine.
You're welcome.
All right. Jermaine did a great job of pointing these things out, and I want you guys to understand that the mortgage industry is an ever-changing industry very rapidly because of technology. Right now, you can apply for your loan on our website, and documents are signed by DocuSign, and methods that are very, very easy. But when it comes to the closing, that's when you meet me, your closing agent. And often, I don't get to talk to you or meet you until that day, until the day you're closing. And that's a little bit unfortunate. I really would prefer if I met you before then. I don't want you guys to be nervous that you're meeting me for the first time that day. But we're going to talk about some of the things that you should know by the time you get there. And if you don't, I'm going to make sure you understand them at your closing. Because at your closing, you're going to sign a lot of documents. And those documents need to be explained to you. You need to understand them. You need to feel comfortable with them. On a purchase, there's no rescission period. You sign your documents and you close, and now it's your house. I want to share with you something broad about this before. You know, as you go into this project to buy a house, you create a team of people. You have your agent, you have your closing company, you have your loan officer, you have your home inspector. All these people come into play, and they need to be people that are comfortable working with each other, because you need a lot of resources that they have, particularly because things are changing all the time in the industry. Now, at closing, I often have to explain to people a few terms, so I'm going to do it for you now. First-time home buyer. Well, first-time home buyer can mean 3 very different things. In the state of Maryland, if you're a first-time home buyer, when you close, you get a discount on the state transfer taxes. That's totally different from being a first-time home buyer in a program with a lender. Lenders create programs that they call first-time home buyer programs. There you're getting a special deal because you're a first-time home buyer. That's the second one. And third, certain jurisdictions like counties actually have great programs for first-time home buyers. They will sometimes lend you some money that's interest-free and no payments for decades. to help you close. So when you're thinking first-time home buyer, if you're not clear on what someone's talking about, ask them, what first-time home buyer program are we actually talking about here? All right, hazard insurance. As you go into this, you're gonna hear the terms hazard insurance and homeowner's insurance, and often people think it's two different policies. It's not. Hazard insurance is what the lender likes to call your homeowner's policy, because as far as they're concerned, that's the part of it they care about. They care about if something damages the house. You care about the whole policy called the homeowner's policy because it covers you for more than just that. It covers you for contents and decor and different other things. So don't be confused by that one. Another common term that's hard to understand for people is escrow account. I'm going to make this really simple for you. It's a checking account that a couple checks get written out a year. That's it. The lender collects some money from you at closing. Every month you make your mortgage payment, but you're paying more than just paying the money back. You're paying some extra money. It's going into the checking account. When your taxes come due, the lender writes a check. When your insurance comes due, the lender writes a check. It really is as simple as that. Closing costs, you will see that we have a closing form called the closing disclosure. This was created a few years ago by the federal government, and they continue to adopt the term closing costs to include things that I consider not closing costs, such as your taxes and your insurance and interest for the future. So closing costs is a term you need to look into. Are all of these things actually closing costs from my lender and my title company, or are some of them taxes and insurance and interest? Make sure you're clear on that. More common than ever is front foot benefit. When a builder creates a community and puts an infrastructure in, the sewage system, the water system, the streets, the curbs, and all that, often he will build that cost into a loan secured by each property in the future. So imagine he says this cost me millions of dollars, and there's 30 homes, and each home is now going to owe me $30,000 and pay me $1,000 a year for 30 years, and I get my money back. That's how that works. If you buy a house, when you buy that house, you jump in on that plan. If you buy it at the beginning, you owe the 30 payments. If you buy in the middle of it, someone has already paid 15 of them, you have 15 left. After that, it's paid off, okay? Liens and judgments. We could spend a lot of time on this. I'm gonna try and make it clear to you that a judgment is when you have a loss of a claim against you. If it's recorded or happens in the county where your property is, and we're going to talk about what circumstances, that becomes a lien on your property. A lien on your property is like a mortgage. You buy a house, you have a first mortgage, and now you have a lien, it's in second position. That prevents you from borrowing money without paying that off. It prevents you from selling the house without paying that off. That's what a lien is. Mortgage insurance. I think the number one thing about this is that mortgage insurance doesn't do anything for them. And that's true. If there's a claim on mortgage insurance because you were unable to make your payments, that money goes to the lender to protect them. The only thing it does for you is it helps you get a loan. Because mortgage insurance exists, it allows people to qualify that may otherwise either not qualify or not have enough money to close on the property. But we all want you to get out of the mortgage insurance as soon as we can, and you'll learn more about that. Loan to value, well, if you buy a house for $100,000 and you borrow 80, your loan to value is 80%. And we've covered mortgage insurance, so now we're going to move on to types of ownerships. Types of ownerships affects everything. When you buy a house, if you buy it by yourself, you're going to be what's considered a sole owner. And if there is a judgment in your community, in your county, and it's against you and you're the only owner, it will be a lien. There's no protection. The other opportunities are that if you buy it with one other person, you can either buy it as a tenant in common, a joint tenant, or a tenant by the entirety. So let's go through those. Tenants in common are where people buy property together, but there's not a real strong bond between them. Let's say I buy something with another person and we're going to rehab it and sell it. I'm not related to them, and if something happens to me, I want my share to go to my children, which means that there's no right of survivorship. If I were to pass away during the ownership, my interest would go to my heirs. The only problem with that is there's no protection at all against a judgment. So if there's a judgment against me or my business partner, it becomes a lien on the property affecting my equity and his. If you choose to do joint tenants with right of survivorship, typically that's like a brother and sister. My brother and I bought a townhouse and we did that. That does carry with it the fact that if either one of us passes away, the property immediately vests in the other person. That's critical because that means that my interest in the property does not have to go through probate. My interest in the property doesn't end up with an heir or a creditor or a brand new partner for my brother who he doesn't know and doesn't want. So that's a really strong attribute to choosing joint tenants. There are also some protections against judgments against me and my brother not becoming liens. Not as strong as the next category. The next category is the best. Tenants by the entirety. This is the strongest protection against judgments, but it's only afforded to people that are married. This was devised to protect the marital home. If a husband and wife buy a property as joint tenants with right of survivorship, we know what the right of survivorship is, but also if any judgment against one or the other, just one of them, happens in that jurisdiction, it is not a lien on the property. So if you own a property as tenants by the entirety, the last thing you want to do is go into business with your spouse and sign the same financial guarantees, because if you fail at those guarantees and there's a judgment against both of you, now you have a lien. So you have to watch out for that. We're going to go into LLCs and trusts, but we're going to do that in the section on investment properties. So I'll come back to that. All right, we're going to move on to the next slide, which is settlement issues and how are transfer taxes and recording fees calculated. Well, each county in Maryland, DC, and Virginia have their own calculation. They're not all the same. But I'm going to tell you that the calculation comes out to between 2 and 2.5% of the purchase price of the transaction. That's a lot of money. $2,500 per $100,000. If you buy a $400,000 house, $10,000. Normal contracts pre-printed will say that the parties split those fees. That's normal. Anything can be negotiated. In Maryland, there is that first-time home buyer discount that I talked about, which knocks off 0.25% for the buyer. And in most counties, only the buyer can benefit from that. If you negotiate for the seller to pay all the fees, the seller will end up paying that too, even if the buyer is a first-time home buyer. But what I want you to remember is it's about as much as 2.5% per thousand, and I want you to remember that the parties split it unless you negotiate otherwise. All right? Next thing we have is, what is owner's title insurance? Why do we need it? What is lender's title insurance? All right, let's start with the lender. A lender decides to lend you money to buy a property. They are taking a risk. That risk is you paying the money back. They're looking at your credit and your income. They want to know if you're going to pay it back. The risk they're not interested in taking is whether that mortgage is actually going to be a proper secured first mortgage, or as it turns out there's a lawsuit because that property has some type of cloud on its title. So they require you to pay for a policy for the lender, hence lender's policy. You have to pay for that policy. They're calculated based on how many thousands of dollars you borrow. Do you have to buy owner's insurance? No, but here's the option. If you buy that house for $100,000 and you put $20,000 down, the lender's going to be protected for their $80,000. Do you want to be protected for your $20,000? And as you own that for the next 30 years, that $20,000 becomes more than $100,000. You pay it off, the value goes up. Now you own a property worth hundreds of thousands of dollars. If you buy that owner's title policy at closing, it will protect you forever as long as you're the owner. You don't have to pay for it again. And there are numerous types of title insurance claims that can happen. So I want you to understand there are two types of owner's policies. One is a standard policy against the history of the property, things like judgments, foreclosures, possibly a deed that had an error and it turns out that someone in the chain of title never signed off and still actually has an interest in the property. There's a second type of owner's policy that I sell often, which is slightly more expensive, called an enhanced policy, and that adds protection for things like mechanics liens. This is very popular with people buying new homes because they're not sure of if all the subcontractors, everybody was paid right up to the day they closed when the house was first finished. So I always advise my clients to consider doing that. All right, let's move on to the next one. All right, 1 to 2 days before closing, you are going to do a final walkthrough. And this is the best way we have, and your buyer's agent will help you with this dramatically. You're going to go through the house. It may be the first time you see the house without furniture, and you get to see a lot more. Normally when you walk through a house and it's filled with a lot of furniture, you really can't see everything. So this is important. And you've already had your home inspection, and I'm a huge proponent of home inspectors and home inspections. The reports are fabulous, and they're very helpful, and they're there for you to give you an idea in the future of what your maintenance costs are going to be. And I wouldn't buy a home without one, even a new home. So you're going to do your walkthrough, you're going to have the benefit of that report, and you're going to have the benefit of your agent being with you to help you with that. You're going to already have gotten your estimate of your closing disclosure, and that estimate is going to be fairly accurate. They may not know exactly the day you're going to close, so there'll be a variation possibly on exactly how much interest you'll be paying for the rest of the month you're in, or exactly how much money will go into escrow, but that minor changes you'll find out from me at closing. Wiring money. Well, I don't know if anybody's paying any attention to the news, but wire fraud is rampant. And even here in the DMV, you might have heard on the news of millions of dollars being transferred to the wrong account. Here's the rules. The rules are you don't wire money unless you've called the source, me, the title company, and verified every number of the wiring information. Because if you accept wiring information by an email, it easily could be a fake email from me giving you wrong information and telling you to wire money to a bank that's not my bank, not Lafayette. So I encourage you guys enough to be really careful about this. It's happening every single day. All right, this is a great time for me to introduce somebody. I have one of our wonderful agents. She's a buyer's agent. Her name is Lynn Spiegel from Buyer's Edge Company, and Lynn's going to come up and talk to you for a few minutes. Thank you.
Good morning. My name is Lynn Spiegel, and I'm an exclusive buyer's agent working with Buyer's Edge in Bethesda, and we are a very consumer-minded company working solely with home buyers in the DMV. I wanted to talk today because it's a first-time home buyer seminar about the process of buying a home and what it entails. And of course, as Jermaine said, the first step is finding a lender. And choosing a lender, I highly recommend that's local. A lender that's in your time zone so that you can speak to them in real time when you need them. A lender that's responsive, that's going to take your call at 7 in the morning, if need be, or 11 o'clock at night. And as Jermaine said as well, we oftentimes stress to our clients, it's not necessarily what your income proves you can afford to buy, it's the amount of money you want to write a check for to your mortgage every month. And those numbers may be very different. After you have a lender, you now know about what price of the house you can afford. You start to think to yourself about neighborhoods. And in real estate, location, location, location. So start to think about, are schools important? And as real estate agents, we can't discuss schools, but I certainly refer you to the websites that will. Same thing with the crime statistics. Refer you to the websites that you can look at the crime statistics in a neighborhood. And then you start asking yourself, do I want to be near a metro? Do I want to be walking distance to shopping? Do I want a backyard, or do I want no land at all? Do I need a driveway? Can I park on the street? Is there street parking? Or no, I must have a garage. These are the things you're going to start asking yourself to narrow down your search for what you want in a home. And then, of course, you have the basics. How many bedrooms? How many bathrooms? Do I want to have a basement? Is it important for a first floor master? And then you look down to the neighborhoods you've narrowed down in all of this. And then you want to know the comps in that area. We call it comparative market analysis. And you want to know how long have houses been sitting on the market? How long did it take to sell the most recent house? Did it go for more than asking, or less? Did the seller offer any credits at closing? So that helps you make an informed decision when you are looking to purchase that house. And in today's world of the internet, everybody goes online and starts their search themselves and looking at neighborhoods and houses, and there are so many different places that you can find homes on the internet and apps that you can drive by and check out that house. The one thing we caution a buyer is not necessarily to look to that listing agent on that home because they work 100% for the seller. So educate yourself of the areas. Do drive-throughs of neighborhoods. Go on weeknights, go during the day, go on the weekend, and see what the neighbors in those neighborhoods, what's going on, the traffic in those areas. Once you get to actually go to see a house, you start looking at the house itself. Does it sit on a corner with a busy road? Is there a stop sign or a bus stop? Is there a highway behind you so you're thinking about noise? You walk around the house, you look at the driveway. Is it cracked? Outside the windows and looking how they've maintained that house. One big thing everybody should look at when they look at a house is the grading of that lot. Because if the grading of the property is toward the house, we think water. If the grading of the property is away from the house, we're less concerned. Walking around the house and looking at those downspouts, you start to see a lot of gravel. That's an indication that the roof is very old. So you continue, and we pay attention to all these things outside, and then we go inside the house. Inside the house, again, if that house was built before 1978, we think lead, because before 1978, there's lead paint. It's only a concern when you start to see that paint chipping, and the prime areas that we see that are windows. So we really take a look at that. And then we look around the house for the layout, is that what you want? And of course, looking at the condition of the house in general. But going downstairs and looking at the HVAC unit, knowing how old that is and the life of that unit. Looking at the chimney from the inside, because all it takes is one look to see if it's been maintained. So you're probably thinking that's a lot of information that you as a buyer are needing to look for. And you might be thinking to yourself now, so who's going to help me best to do that? In a Kiplinger article, the Associated Editor recommends strongly hiring a member of NABA. That's their National Association of Exclusive Buyers Agents, to protect the buyer. A Bloomberg article on first-time home buyers said hiring a buyer's agent is like hiring your personal shopper. And a New York Times article on first-time home buyers suggests that an exclusive buyer agent eliminates all conflicts of interest because they do not take listings. As an exclusive buyer's agent and Buyer's Edge and all the agents that I work with, we work 100% of our time with you as the buyer. We have no inventory of houses, and we have no incentive to sell you any home other than what you're looking for. Our goal is to find you what you've narrowed down is your choice. So as your buyer's agent, I'll create that search with you to narrow down the number of rooms, a backyard, a driveway, a garage. I'll run the comparative market analysis, analyze it, and educate you on the neighborhood you're interested in. I'll set up every tour to take you physically to every house. And when I take you to each and every house, I'm going to point out everything I just discussed that we need to look for. I will advocate for you as the buyer, strategically writing a purchase offer, knowing if we're in a competitive bidding, knowing if it's Thursday and we want to go see that house and the selling agent is having an open house on that Sunday and what that means to you. And as we write that purchase offer contract, I'm going to put in the contingencies in that contract that will protect you as the buyer. And then of course negotiate the term of that contract. Once it's ratified, meaning that contract was accepted, I am part of that process and seeing it through to closing. So I will set up the inspection. I will be there at the inspection. I will review that inspection report with you. And then I suggest the title company, Stephen. And what I highly recommend is that the day of closing is not the first time you speak to him. I have each and every one of my buyers speak to the title attorney in the very early phase so that they understand what that closing means. I'm transparent through the whole process, and I work tirelessly with my buyers. So I thank you for your time and attention, and I hope you understand now what my distinct advantage in this real estate climate is. Thank you very much.
Thank you, Lynn. Lynn also has business cards on her table if you guys want to grab a copy. I do want to mention, because I did leave a piece of information out on my last presentation, and it's basically a pre-qualification versus what a pre-approval is. If you're a first-time home buyer, we'll get it up for you guys here. If you're a first-time home buyer or you're in the market to purchase, you'll start off being pre-qualified. Pre-qualified just means you went online and you'll get an estimate of how much of a loan you qualify for. It's not necessarily a firm commitment, but it is something to get you started. Now when we talk about a pre-approval, this is more firm, and it means a lender or an underwriter has actually analyzed your pay stubs, your W-2s, your tax returns, and ultimately your bank statements verifying that you have enough funds for closing. So if you're a buyer and you're pre-qualified, the goal is to get to the pre-approval stage, and that's when the process really starts to move you towards closing. So that's all I'll have to say about that, and I'm now going to kick it back to two realtors that I've worked with personally. I like them, I enjoy them. They were referred to me by an employee here at Lafayette, and the first time I think of anybody that needs a realtor, they're the couple. Tim and Mandy Herson, they're really good people, and they work with DCRE Residential.
I gotta tell you, I'm ready to hire Lynn at Buyer's Edge myself right now. Yeah.
We have some handouts. I don't know if everybody got one. There's some more on the table over here if you want to follow along. As Jermaine said, my name is Mandy Herson. This is my husband, Tim. We work together. We've been selling real estate for over 12 years now. We're licensed in DC, Maryland, and Virginia. And normally when a buyer is referred to us, the first thing we do is meet for at least an hour. We go over the process. We ask a lot of questions. Try to find out, what are you looking for? What are your goals? What's your timeline? What's the ideal house for you? We don't have that much time today, so I'm just going to do a quick overview. First, we'd like to talk about the financial advantages of home ownership. Owning is cheaper than renting over time. My husband was in property management for over 25 years, so he can tell you that rents tend to not stay the same, they continue to go up.
Yeah, I mean, I worked in Southeast the last 10 years, Southeast DC, where rents are much less than they are in the rest of the world, but they doubled in the 10 years I was there. As opposed to if you invest in a mortgage, like Jermaine said, it remains relatively stable.
Your principal and interest is going to stay the same for as long as you have that loan, 15 years, 20 years, 30 years. Homeowners get tax breaks. Some of this stuff is going to be repetitive.
All of them were repetitive, I think. Right?
Yeah, but when you own your home, the interest that you pay on your mortgage and the real estate taxes are deducted from your income, so that's a savings. You also earn tax-free profits when you go to sell. Up to $250,000 for a single person is protected from capital gains, and $500,000 as a married couple. You also get leverage. You're probably not going to buy the house with cash. You're probably going to get a loan. So most of that money is going to come from your bank. But your bank only gets paid back what they owe. Any profit that is made is all yours.
And, you know, a good example is if you wanted to buy $250,000 worth of stock and it made $10,000 over the next 2 years, you'd have this $10,000 return to be about, I don't know, a couple percent return. If you bought a $250,000 house for $10,000 and it appreciated $50,000, you'd make 500% of that money. So it's leveraging your money is the key to investing in a property versus investing in other commodities.
Also, it's been well documented that homeowners tend to save more money than renters, probably because it's a big responsibility owning a home, and you know there are things that are going to come up that are going to be your responsibility. And the freedom that you get when you own your own home. You can paint the walls whatever color you want, remodel the kitchen, add an addition. You can't do that when you're renting. Okay, so next we'd like to go over preparing for home ownership. Some good steps to take. First, deciding how much you can afford. Jermaine can tell you how much you're approved for, and usually that is more than you really want to spend. So really what you want to know is how much do you want to spend every month on your mortgage?
Yeah, that's the key. You're not looking at, do I want a $500,000 home versus $400,000? You're looking at what your payment's going to be. What am I comfortable with? I mean, Jermaine said, hey, you can make a $3,000 month payment. You may want to just make a $1,500. So you're going to key in on the payment per month, what's comfortable for you. Yeah.
And then develop a wish list of what you're looking for. A lot of times we tell buyers, no matter how many lists you make of what's important to you, sometimes you walk into a house that doesn't check off every box, but it just feels right. It's a very emotional decision, and only you can tell the house that's right for you.
And here's how we're different. I'm very analytical. I'll look at everything on your criteria, and I'll analyze it and talk to you about it. Mandy's a very feeling kind of agent, and I got to say, most of the people that buy through us actually feel it when they walk in. And most of the time, I don't know it. She's in tune with it, but it really is an emotional decision.
So then selecting 3 or 4 neighborhoods that you'd like to live in. Some people come to us and have no idea whether they want to live in DC, Maryland, or Virginia. The more you can narrow that down, the better and less overwhelming it's going to be for you.
Yeah, we'll keep asking probing questions as we sit down and as we go through our relationship. It'll help you understand where you want to go. And I think the key is we don't make decisions for you. We just offer information, ask questions till you come to your own conclusions, and we don't do that every day.
Yeah. We listen. And then determining if you've saved enough for your down payment and your closing costs. Jermaine can walk you through your different options of down payments, and you can figure out what's best for you. But on top of that down payment, your closing costs are going to be about 3% of the sales price. So that's something to keep in mind. In many cases, we can get the seller to pay your closing costs so that all you have to come up with is your down payment.
It all depends. You know, if a home's been on the market for a couple of days, chances are the owner's not going to be very amenable. But if it's been on the market for 30 to 60 days, as a lot of homes are in Maryland, and you want to make an offer with closing costs, you can get, you know, $10,000, $15,000 of your closing costs paid by the owner. You don't have to bring that money out of your pocket.
So a couple people have already talked about credit. It is important to, even if you think you have good credit and you've always paid your bills on time, you have to get your credit checked.
Why?
Well, I mean, in light of what just happened with Equifax, I was actually a victim of identity theft, and didn't know it until I received a credit card in the mail that I
Yeah, we had a J.C. Penney's credit card. We didn't know we had. It was maxed out.
Yeah. So, and then just being organized and ready for this process to begin. Your loan officer is going to need a lot of documentation from you. Tax returns, pay stubs, bank statements, W-2s. Get all that stuff together, put it in a PDF, be ready to send it off to him. Save you a lot of time. Also, do your research to find out if you qualify for any down payment programs. We can help you with that too. That's something that we do at our first meeting. Once we have a better idea of you and your financial situation and where you're looking, we can let you know if you qualify for maybe any, you know, city or county programs, as well as programs that the bank has. You want to have a good idea of what the costs of home ownership are going to be. Again, Jermaine is going to do the loan estimate and tell you what your down payment, your closing costs are going to be, HOA fees, you'll find out about. And then finding an experienced real estate agent to help you. It saves you time, it saves you money, and there are lots of deadlines throughout the contract that you're going to have to meet. Your home inspection deadline, your appraisal deadline, your financing contingency deadline. We manage the transaction for you, so all you have to worry about is finding the perfect house. We make sure everything happens when it's supposed to.
It's very important to meet those deadlines because if you miss one, it could jeopardize the contract and the home you've been thinking about for a long time.
So you find the perfect house, you're ready to make an offer. We do all the research for you to make sure that the sales price that you're offering is really what that house is worth. And we do that because eventually you're going to have an appraisal done, and you need it to appraise at that sales price, or you won't be able to get your loan.
We go through the same process that an appraiser does, look at the last 6 months of sales in that area with a certain radius to determine what we think the market value is. Usually it's pretty accurate. And also, we do that before you make an offer. So if somebody's offering a house for $500,000 and we do an analysis and say, hey, the market's $450,000, we don't tell you what to do, but now you have the information at your disposal to say, I really want that house. I think I might offer $480,000 for it, or hey, he's offering too much. We're going to offer $440,000. Just give you the tools you need to be able to make an informed decision. That's what we do.
We usually create a spreadsheet that shows you all the recent houses that have sold. How many square feet were they? How big was the lot? What amenities did that property have? So that you're comparing apples to apples. Once your offer is accepted, from then until closing is usually about 30 to 45 days. It's negotiable, every situation is different, but in general, it's 30 to 45 days. It goes pretty fast. First thing you're gonna do once your offer is accepted is have your inspections. We have many inspectors that we've been working with for years so that you don't have to go out and do that research. We set up the inspection for you, we attend it. You can do a regular home inspection, radon inspections are becoming much more popular, termite inspections. So once all that is done, we come up with a list of the things that were wrong with the house, and we go back to the seller and negotiate on your behalf to get those things taken care of. Assuming all goes well there, and you still want to go forward with the transaction, you don't have to. Just so you know, if you find out a lot of bad things at the home inspection, you can choose to walk away, or you can choose to have those things repaired. And you get your money back, so you're protected. So once the inspections are done and we've passed that phase, the next thing that happens is Jermaine orders an appraisal. An independent appraiser goes out, he does the same things that we did. He considers all of the houses in the area that have sold, and he determines a value. As long as that value is the sales price or higher, then we keep moving forward to closing. Then the title work and the survey are done, and that is something that Stephen takes care of to make sure that you're getting free and clear title. There are no liens on the property, and for that you're going to pay for a title insurance policy that protects you for as long as you own the house. Once all that is taken care of, then we get the loan approval from Jermaine, and we're ready to proceed to closing. Right before closing, we do the final walkthrough. If there were things the seller was supposed to fix, that's when we make sure they were fixed, and we make sure we have receipts from licensed contractors showing that they were fixed right. And then we go to closing. Closing is the same as settlement. Usually the seller and their agent attends, buyer and their agents, settlement attorney, sit around a table, you sign all the documents, and at the end of that you get your keys. So that's the process. And then a little bit about us. As we said, we've been in the business for over 12 years, licensed in DC, Maryland, and Virginia. We were featured in the Washingtonian in July as top agents in the metro area for doing over $15 million in sales. 3 years in a row we've gotten the 5-star designation, and that's very important to us because it was based on customer satisfaction surveys. So those are our customers saying we're 5-star agents. We also have the GRI designation, which just means we went to school for 90 hours more than most real estate agents. We have 6 pages of testimonials from past clients that we're happy to provide. This is all we do. We do this full time, 7 days a week. Most importantly, I think we're very responsive. We answer our phones. We respond to emails. Jermaine can tell you when he calls me, I pick up the phone.
That's the key. We're, not that we're on call 24/7, but we work 7 days a week, and because we enjoy it. So it's important in a realtor that, or any profession that you engage, that they respond to you, either by email, text, or a phone call. And that's what we do, and that's what people appreciate most about our service, is that we're responsive. There's no such thing as a dumb question. We'll answer all your questions because we do this every day. It's something that we're just immersed in, and then we enjoy, right?
Yep.
And if you think about reaching out, and in the old days when I was younger, you had to make a phone call. You had to think about it, rehearse it. What do I have to say? Now you just type out an email. Answer when you want to answer. So if you've got questions you want to have answered, text, email. Don't tweet me. I'm on Twitter, but yeah.
We're also accredited staging professionals, which doesn't help you as a buyer, but when you go to sell your house, that's a service that we provide free of charge. If you're living in the home, we can take the furniture that you have and professionally stage it. If you're not, then we have furniture that we can bring in.
Yeah, one of the things that Jermaine had up here on his slide was the cost of purchasing a home. What he didn't have up there was the cost of the buyer's agent, like Lynn themselves. It's because the seller pays the cost of that. So some people will say, well, it's built into that. Not really, because the seller already goes into thinking that he's got to pay that, and puts it appropriately in the market. And so we can help you understand those prices.
Yeah, when a seller signs a listing agreement, they've already put in writing how much they're paying the agent that represents them
Right.
in their best interest, and how much they'll pay an agent that brings a buyer. There are some companies that charge administrative fees to buyers. We don't do that. There's absolutely no charge to you. So it makes sense to have somebody who does this all day, every day, guide you through the process and bring their team of professionals to help you throughout the process. Lastly, we never pressure anybody. We've been doing this for a long time. We plan to do it for the rest of our lives. And this is all about you. We never lose that focus. This is about you, your goals, and your timeline. We have worked with some people that took 3 years to buy a house, and happy to do it. As long as you're happy in the end and you got what you were looking for, that's all we need.
And we work almost strictly by referral, so that's how we build the business. And as far as networking goes, we also have a lot of contractors that we have that we've vetted over the years. We've been in business for 25 years. And so that if you've got a problem with your furnace and you want to just go onto the internet and look for somebody, we can suggest people that we've used over the years that are very inexpensive, that know what they're doing, that are show up on time and take care of your problem. So that's all part of the service that we offer.
Tim, he has a degree in engineering and his background is construction and property management, so he understands systems and he can, at a walkthrough of a house, look at the electric and the HVAC and the plumbing and point out problems before you even get to that home inspection, so that's very helpful. And lastly, with every transaction, there are always bumps in the road. There are things that come up that you couldn't have planned for, and the good thing is there's almost nothing that we haven't been through before, so we're very proactive and good at problem solving.
The last thing we'll say, we done?
Okay.
Is that I have on good authority that nobody handles your finances better than Lafayette Credit Union.
I want to thank Lynn and Tim and Mandy. They're great. We couldn't do this without all the experts that we need, and obviously these are extremely experienced people. They remember all the things that need to be evaluated for your deal, and you need that. We talked about a team, and the team is made up of your buyer's agent, your lender, your title company, and I always like to point out your inspector. So when you're going through this process, yeah, it's a bit overwhelming, but these are the people that keep this organized for you, keep it clear, make sure nothing gets skipped, and help you a lot. I can tell you that all three of us could have talked about more issues, but we don't have enough time. Every case is different. You're different, and what you're buying is different. So as you go through the process, they're going to kick in the gears that they need to kick in from their experience to make it work for you. I know you're all probably thinking after watching everybody that I lied about them not being professional speakers. They did a great job. They seem like professional speakers. They're actually just professionals at what they do, and I love that. They're really wonderful. I want to mention to you something else about what a buyer's agent does for you. They help you structure a deal, and Lynn mentioned that I come into the deal before the actual closing, which is really helpful. Sometimes I play a role in that too. Structuring a deal is critically important, and I'll give you two good reasons. Number one, when you're trying to make an offer on a property, and in this market there may be other offers coming in, you want your offer to be the one picked. This is where having the right agent really matters. And they know how to structure a deal so that the listing agent and the seller like your contract the most. There is a lot that goes into what I just said, and they know how to do it, and I know how to help them with it. I also get involved to help prepare you by doing your final closing disclosure long in advance. I sometimes do them before you've even made the offer to give you an idea of exactly how much money you'll need at closing. So you're going to be working with your loan officer, but you're also going to be working in conjunction at the same time with your buyer's agent and your title company to make sure you're going through all the issues and you're going to get that property that you really like. Seller credits can come into play. Obviously what you offer, appraised price, and closing dates. You know, people think whoever offers the most money gets the property. That is seldom the truth. When there are multiple contracts that come in, seldom is the highest price coming in the one that is chosen by the seller. They're more concerned with other things. Contingencies, how much cash there is, how likely you are to get your loan. So that's why you really need the benefit of these people. All right, let's see. We're going to bring Jermaine back up. Can we do questions now?
Let's do questions now.
All right, let's do questions and answers. We have Facebook available. You guys can ask questions, and we can answer questions here. And you can ask questions of any of us that have spoken. Do I have any? Yes, ma'am.
When it comes to providing documentation, like your W-2s and bank statements and so forth, how far do you go back? Is it like a year, 2 years?
That's a Jermaine question.
Did everybody hear the question? Okay. That's a good question, and typically it's a 2-year history. If you're self-employed and we're doing an average, sometimes it may be 3. But to give you a quick rundown, it's your most 30 days pay stubs, so that's typically 2 or 1 if you're monthly. Your W-2s for the past 2 years, your tax returns for the past 2 years, including all schedules if applicable, and bank statements for the past 60 days.
Thank you. Yes, ma'am.
Is this a question for Lynn? When you were speaking, Lynn, you mentioned something, and I think the term was graded, and I had no idea what that was.
Graded, I'm sorry. So if it's like the slope of the property. So if you were standing at the house and looking out from the house, if you saw the backyard slanting toward the house, that's something you want to pay attention to because water goes downhill. Okay? Typically, we like to see the grade of the property away from the house. So it's just the slant.
Well, that's just one of the features and things that someone with experience would think of that you might not. You're looking at the shutter, she's looking at the ground. Anybody else? Yes, ma'am.
Okay. If I own a house, let's say I own a house like 7 years ago, and the house was foreclosed.
Yeah.
It's been 7 years, and now I want to go back in the market to look for a new house. Will I be a first-time buyer, or will I
Okay.
be considered as a first-time buyer?
So we have to look at the 3 different definitions of first-time buyer. If you own that house somewhere outside of Maryland and you're buying a house in Maryland, you will be a first-time home buyer. Okay, now, when it comes to first-time home buyer programs with your lender, I have to defer to Jermaine on that. Can you tell us about that?
Yeah, we've recently revamped our definition of a first-time home buyer. And if you haven't been on title for 3 years, for the previous 3 years, you would be eligible for our first-time home buyer program, given the fact that you qualify.
And then the final type of first-time home buyer with some of these county programs, it's case by case. You have to look at the program to see what the definition is of a first-time home buyer. Yes, ma'am.
Yeah, this is a question for you. You just mentioned the tax return. So for people who are doing like deduction on the schedule,
Yes.
how can that affect you? When
Um,
you looking for money?
Yeah, the question was, when you review tax returns, do we take deductions into account? And the answer is yes. When an underwriter is looking at your tax returns, she will look at all the itemized deductions that you've taken. Depending on the schedules, there are some ways to add back some depreciation, but it is taken into account. And if you don't have the depreciation, it could potentially drive your income down. So that is something to think of when you submit taxes or you're filing your tax returns.
Thanks, Jermaine. Yes, sir.
Now, earlier you were speaking regarding the types of ownership.
Yes.
I'm particularly interested in the LLC and the trust. We didn't get into that, but does Lafayette does any type of funding for that? And then for you representing that type of transaction, is there any, how's that work?
Okay, we're going to talk about how they benefit you later, but right now I'm going to answer your question about when you choose to do a trust or an LLC, your lender has different programs that may or may not apply. So you'll be talking to someone like Jermaine to say, well, is this going to be the right program? Am I going to make the right decision by putting it into this type of organization? Am I still going to get my loan? Okay, so that's a really important question. We'll go into it a little more later. Okay? Thank you.
Well, it sounded like it was a 2-part question.
Yeah, from a funding and a
Yeah,
transaction.
well, from the lender's perspective, we will not hold the loan in an LLC or a trust. You'll have to be the personal guarantor for that. But the title, you can possibly hold in the trust, whether it's an LLC or something along those lines.
Gotcha.
So the lender won't, but the title company will.
Makes sense. Thanks.
Any more questions?
I have another question.
Okay.
This was on the PowerPoint tonight.
Yes.
I think that was the slide, where you have the first time home buyer, different discounts, additional 1.5% discount on
Yes.
the first aid, the 10%. Can you go back and explain?
Of course. Absolutely. I'll go over the slide again. So right there, the question was basically a little more information about the first-time homebuyer program. So Lafayette will deduct 1/8 of a percentage point off of your interest rate, whatever it is for that debt. So if it's 4%, you'll get a rate of 3.875 because you're a first-time homebuyer. The 10% down payment with no PMI, most loans that you do require separate mortgage insurance if you're above an 80% loan to value. So the first-time home buyer will allow you to go to a 90% loan to value without private mortgage insurance, okay? And then as little as 3% down. We'll do 97% financing on our first-time home buyer, but that program does require separate mortgage insurance. And then there's no closing cost options. We have programs where, depending on how much you want to cover in the closing costs, we'll slightly increase the rate, but for cash flow purposes, it may be beneficial for you. And down payment assistance programs, we have some of those available through our website, and it's a detailed explanation of if you qualify and how much it is. I think now it's like for every dollar that you put in, the down payment assistance programs will match it up to $4.
Jermaine, I know we're going to go to the home equity presentation,
Yes.
and you both are available after for anybody that has any questions. But there's one thing I want to ask that I think may benefit that we skipped during the presentation was how do you get your down payment?
Yes.
If
Thank
you don't
you.
mind going through that real quick?
Absolutely. So assessing your financial resources. How much do you need for a down payment? The first one, obviously, if you have a savings account and you've already been mindful about purchasing a home, you can dip right into your savings account if you have the money there. I always tell people you can't just wake up one day and say, I want to buy a home. It's a process. You got to think about it. You got to plan. It's strategic. You want to make sure it works for you. And retirement account loans. I'm a big fan of if you have a retirement account, if it's a 401k or it's a TSP, you can borrow from yourself and pay yourself back at an interest rate. So that's even more beneficial for you. We do allow private gifts if you have a relative that wants to provide a gift. We just do require that that gift is not a loan from another source. And your giftee will be required to complete what's called a gift letter. And my processor will send that to whoever is providing the gift. Second trust, this is something that we do too if you want to avoid paying mortgage insurance. We could do a first trust loan at 80% of the sales price. And then we could do a second trust loan for 15% of the sales price. If it works out for you where you're avoiding the mortgage insurance and that 15% is a lesser payment, you may want to take that route. The good thing about me, I'll analyze every situation and you can tell me which best suits your financial needs. And then the other key component is FHA and VA financing. We do offer those types of government-backed loans. And they do have down payment assistance programs for those as well.
Thank you.
Yep.
One more question?
Yeah.
Is there a limit on private gifts?
No, there's no limit.
Okay.
And then for the 3% down program, what's the ideal or minimum FICO score to qualify for that?
That's a good question. I want to say I don't have it. I do have it in my office. I want to say 700. But I can follow back up with you on that question to make sure I'm 100% sure. Because you're right, it is a credit score criteria that you have to have in order to get the 97% loan.
Thanks.
The other slide said 10% plus a down payment.
Well, yeah, it's not 10% plus the down payment. 10% is the down payment to avoid the mortgage insurance on the first-time home buyer. Non-first-time home buyer, it's 80%, no mortgage insurance. If you want 90% financing, non-first-time home buyer will require mortgage insurance.
Okay, we're going to go to the home equity. Again, both of these kind gentleman and the realtors are available after for additional questions, and we'll just keep going.
All right, well, for those of you that are joining us on Facebook first, my name is Jermaine Medley. I'm the Vice President of Mortgage Originations at Lafayette Federal Credit Union. Home equities, our expert guide in home equities. Sorry, I skipped it. What is a HELOC? A HELOC is a home equity line of credit, and it is a revolving credit loan using your home as collateral that lets you borrow up to a certain amount rather than a set dollar amount. What is a fixed rate equity? It's a loan that's fixed and you use collateral from your property, and it's a consistent monthly payment. Those are the two types that we offer here at Lafayette. A home equity line of credit, which is abbreviated for HELOC, and our fixed rate equity. What's the primary usage? A lot of people take home equity lines of credit or a fixed rate equity to consolidate debt. And this goes back to if you're a first-time home buyer, we have a consumer loan department here. If you want to save some money on consolidating that debt, you can do that first before you apply for the mortgage, just to make sure you're qualifying for that mortgage, and again, you're comfortable with those payments. When you do own the home, another good usage is home improvements. You buy the home, you want to upgrade the bathroom, or you want to fix your bedrooms, or you want to finish the basement. We offer those vehicles to allow you to do that. Student loans. We talked about that earlier. If you have student loans, you could actually pay those off with a home equity line of credit. I deal with a lot of parents who pay tuitions by using a home equity line of credit. So something you consider when you own a home, and it's a good benefit to have, especially if you built that equity. And last but not least, a lot of the membership here like to take home equity lines of credit for a safety net, an emergency fund. I know when kids run into issues or something breaks, you want to be able to have that money to get things fixed immediately rather than going through the whole approval process and waiting. It's always good to have that safety net on hand. How to qualify. One of the key components, as you all know, with any loan, we have to verify your income. It goes back to the ability to repay. And then the other part of it is, how much equity do you have in your home if you're going to try and get a second mortgage or a home equity line of credit or a fixed rate. We do require that you get an appraisal done on the property so we can determine that actual value. And this is important because a lot of the people who get appraisals done through the lender, we order the appraisals through a management company. It's a blind order. I don't know who the actual appraisal is. After 2008 and the Dodd-Frank Act and all of these changes in the industry, it separated loan officers from dealing with actual appraisers. So now, if you're an appraiser, I can't call you up and say, hey, could you go out and do this appraisal for me? Now we have to blindly send the order, and whoever gets it, they get it. That being said, I don't know how much each appraiser costs either. So the first appraiser may charge you $450, another appraiser may charge $500, the other appraiser may charge $400. Whoever you get, that's what you'll pay. I typically overstate the fee and say it's going to be $500 for that appraisal. So we're going to charge you whatever the invoice is. We're not going to, if I said it's $500 and it only came back at $400, we'll give you that $100 back. I'm not going to pocket it. And lastly but not least, this is important because I get this question probably every day. Can I do a home equity line or a fixed rate equity on an investment property? Here at Lafayette, we do not do second mortgages on investment properties. We will allow you to do a second mortgage on your primary residence or your second home. What are the loan parameters? So Lafayette Federal will go up to a 95% total loan to value. Here's a perfect example. If your property appraises for $350,000, you can borrow up to $332,500 minus the balance of any other outstanding property loans. So if you have a first trust for whatever the amount is, we'll go up to the maximum of $332,500 in this example to get you to a 95% total loan to value. Our maximum loan amount on those programs are $500,000. We offer, again, as I mentioned earlier, a HELOC and a fixed rate term. And the difference between the two, it's very simple. On the HELOC, you're only charged the interest on money that you borrow. And for example, if you get approved for a $500,000 HELOC, but you only use $20,000, you'll be paying interest on the $20,000. The other $480,000 will just sit there and it'll be available to use at your discretion. And that's the same thing on the fixed rate. It's a little different. If you select the fixed rate term, we will give you a fixed rate loan and you'll pay us back over a 20-year period, whether you use the money or not. So the difference is the fixed rate equity, it's fixed and we'll disperse all of the money to you. You'll have to pay us back over a 20-year period. And then the HELOC, you're only charged interest on money that you borrow. So depending on the usage, I would recommend a HELOC or a fixed rate. For example, if you were doing home repairs and you're shelling it out on different disbursements, it may be wise for you to use the HELOC. But if you know you're going to use all of the money, it may make sense for you to do the fixed rate term because that payment's fixed. What we want to really know about the repayment. So each program calls for you to pay your monthly payment at the end of every month. Whether it's a fixed rate or a HELOC, you'll be paying that monthly payment at the end of each month. What are the loan terms? So on the home equity line of credit, you'll get 10 years to draw and 10 years to repay. On the fixed term equity, you'll get 20 years amortization and you'll pay it over a 20-year period once it's paid off. Okay. And that's pretty much, oh, and this, is it tax deductible? I get this question all the time. Jermaine, if I take out a home equity line of credit, can I write that interest off that I paid in taxes? And the answer is yes. Both loans are tax deductible, but obviously you want to consult with your tax accountant for specific details on how to structure that interest income. Is the documentation required the same as it is on the first trust loan? The answer is yes. We'll require pretty much the same documentation that you would if you were doing a first trust loan versus a second trust loan. We're in a full documentation environment, so all of that is applicable.
The cost? Can we go over the cost?
Oh, I'm sorry, I did skip the cost, I apologize. Costs are pretty much identical between both loans. We do charge a $500 origination fee. Stephen will require that we have title insurance and any third-party fees, appraisal, credit report, etc. On the fixed term equity, the costs are the same. The only difference is we charge initial interest if the loan is going to be fixed. So if you close in the middle of the month, we'll charge you a prorated fee to the end of the month, and then your payment is due the end of the next month. And you'll see that on your good faith estimate when you go to settle. Did you guys have any other questions? Do we have any questions coming in on Facebook as well?
I have a quick question. You said title insurance. That means you already have title insurance in place, you have to purchase additional?
You do have to purchase new title insurance, but Stephen will make sure he'll give you a reissue rate and it'll be discounted. Right, Stephen?
Yes.
What's your question?
For the HELOC, the 10-year, what was it?
10-year draw and 10-year to repay.
What happens after the 10 years if it hasn't been repaid?
If it hasn't been repaid after the 10 years,
So if you draw within that 10 years and then you just spend 10 years just paying the monthly payment, and after the 10 years there's no repayment, are there any issues with that?
I'm not sure I understand. Well, it is an issue if you stop paying after 10
No,
years.
if you continuously pay the monthly, I guess there's no limit until how long you can actually have that balance.
Sorry, I don't understand your
So the
question.
balance is spread over 10 years, right?
Yes.
But it's a moving target, right? If you borrow money in the third year, you have 10 more years to pay it off. It doesn't end after a 10-year fixed period.
Well, I think I understand the question now. So we're just saying you have 10 years to draw that money. You have to draw the money within a 10-year period.
Gotcha.
But what happens if you pay it within the 10 years?
What's the question?
What happens if you fail to pay it within the 10 years?
Well, it's delinquent at that point.
It becomes amortized after that. So you only have 10 years to pull money off of that. And after that point, it's best to refinance the loan, but otherwise it becomes amortized and you get a payment schedule.
So if you're 10, you borrow $10,000, you have a few months to pay it off.
Well, no, that would be too difficult to do. So
Yeah.
they amortize it over a period of time.
Right.
It depends on which note you sign, and that's what I go over with you
Okay.
to show you how that works.
So it becomes a loan after 10 years.
It does, and one of the options you have is to refinance that again, ask for an extension, or refinance and consolidate your existing first mortgage and that.
Gotcha.
No, because you're only paying the interest you actually suffer. You never pay anything else, and there's no payment penalties on any of the loans that Jermaine's talking about. Yes, ma'am.
What expert do I need to talk to about, it appears that the neighbor's fence is on the property that I plan to buy, so who should I talk to?
That's me. So she asked, what do we talk about when you have a property dispute, a boundary line dispute with a fence? I'll let you know that things have changed. We used to make every buyer pay for a survey which determined if fences and houses were on the property. And we stopped because it was a lot of money for people. But if you want title insurance to guarantee to you that there's no dispute about property, I'll order the title survey for you, and I'll determine if there is a dispute. If there is a dispute, I'll help you resolve it. Otherwise, I can't issue you title insurance, because that can be a claim on your title insurance policy. Okay? Anybody else?
Are the interest rates typically higher than you want?
The interest rates are not typically higher for the HELOC, but when you take a fixed term equity, in my experience, the payments are typically less. So, and because the way we calculate it is, we assume that you're going to draw the full amount. So if you get a $100,000 loan, I have to calculate or qualify you with the assumption that you're going to draw the full amount, because you can.
Right, so Jermaine's determining, can you afford the payment if you've drawn it all? Because we're going to let you do that.
Yeah.
And you're going to see at closing and before closing that there's a schedule that says, well, if you owe $1,000, you pay $7 per thousand at closing if your interest rate is, let's say, 5% based on the current calculation. If your interest rate is 6%, you may have to pay $8 per thousand of the balance. If you owe $10,000, your payment is $80 that month. That's something we'll sit down with you and explain. Okay? Do we have time for more questions?
We do.
Sure.
Any more questions?
Is there a variable interest rate for the HELOC?
Yes, it is a variable. It's tied to prime. So if prime increases, it's calculated on a monthly basis. If prime increases, your rate could increase.
Okay. All right. Yes, ma'am.
It seems that tax return are very important during this process. What if, as a couple, you plan to buy a house like first home buyers, and only one partner is paying taxes, the other one is not? Are there any issues with that? Is it acceptable, or rather in tax if only one?
Okay, so Jermaine's going to address that. The question is, what happens if there's two people, maybe a husband and wife buying a property, and only one of them has been filing tax returns? How does that affect qualifying?
It does affect qualifying. It does affect qualifying if I need your income from both parties to qualify. Ideally, it's about structuring the loan. So let's say you filed taxes and you paid taxes and your husband didn't. It may be the only way to do the loan that's qualifying in your name only. If he doesn't file taxes and we need his income, we probably would want to get those taxes filed so we could use that income.
But what if you're married and you don't pay taxes because of your status, like a diplomat? You don't. Exactly, you're not supposed to.
For who doesn't pay taxes? I'm sorry. Oh.
Yeah, you're not supposed to. It's not that you don't want to.
Yeah, I mean, if you're not required to pay taxes, then that's fine. I could use it. I thought the question was, you owe taxes and you don't pay.
No.
Okay, I'm sorry.
No.
Yeah, if you're exempt and you're tax exempt, that's fine. My underwriter will take that into consideration.
Okay, that won't disqualify you from getting certain discounts.
No, not at all.
Additional questions? We still have a few more minutes.
I just need to become a diplomat, so.
We all do.
I think we're all with you. Question over here.
I have a funny question, but I'm not, that's too late.
That's okay. We'll give it a try. What is it?
When it comes comes to credit, building your credit or whatever, and you have like, say, 2 credit cards, and if you pay them off, then it's considered bad credit if you don't use them, opposed to using them and keeping, what, at least 30% available fund? How does that?
Well, that's a good question. I have a person I'm doing the loan now for right now, and they're not heavy users of credit, and it's kind of affecting him. So think of it as a game, because that's basically what it is. And if you're not utilizing credit and being responsible with that credit, the credit agencies look at that as a bad thing. So it's kind of like they want you to play their game, but you have to beat them at playing their game. So it's important that you have open lines of credit, be responsible in making the payments on time, and don't press up against whatever that limit is, because that could actually drop your score. Because they're, in their mind, they're thinking that you're living off of discredited if you're at the max. So I hope that answers the question.
Yes. I have a second question. So it's also not good to close your account either, right?
Yeah, because you're not playing the game anymore.
Right. When someone makes the statement, I have credit, it's a great question. What's the definition of the fact that you have credit? And the answer is that you're using your credit. You're not using it too much, and you're not using it. So for those people that are maxing out their credit cards, they don't look responsible. For those people that don't have credit cards or have them and don't use them and don't have a loan on their car, but have lots of money, believe it or not, they don't have a lot of credit. So game is probably the right word. It's a calculation that you have to work with. Okay? Yes, ma'am.
I've seen some advertisement on mortgage interest where I never understood that. Why is it that the mortgage interest rate is always lower and then the APR is higher? Then I think they calculate everything with the APR. I just don't get it.
That's a good question. That's a good question, and I'll repeat it. The young lady said she sees advertisements all the time where the interest rate is low, but the APR is high. In that case, if you see something where an advertisement where the interest rate is low and the APR is high, you want to definitely fine tune and look at that loan estimate. Because I can tell you 9 times out of 10, they're charging you something that's extremely high. We like to call it hidden fees. So if you're seeing an interest rate hypothetically at 3.5%, your APR shouldn't be in the high 4s. It should be 3.8 or 3.6. That means that there are no costs hidden in that loan.
So let me define this for you, because it's been very confusing for many years, ever since they came up with the concept of what is APR, annual percentage rate. If you have a loan at 3%, where the note says your payment is calculated using 3%, but your APR is 3.5%, that means that they were taking into account the costs you paid at closing to the lender. Costs to a lender are considered interest. So from the day that you close on the loan on, you're paying 3%, but at closing, you paid a bunch of fees. 3% over the life of the loan, plus those fees, would have been the same exact calculation as 3.5% over the life of the loan with no fees. The concept came up when they were concerned about consumer protection. They said, well, one plan that was offered from one lender to the consumer was that they were going to have 4 points, 4% charge at closing, and 3%, and the other lender offered them 2 points and 4%. Which one is less expensive? The answer is in the APR. If you calculate the APR for both loans, you put them on an even level to compare to each other. I hope that helps.
Any additional questions?
Is there a term limit for refinancing?
Is there a term limit for refinancing?
I mean, for instance, I have a mortgage and I have a second mortgage with, which is a dealer.
Okay.
With another bank. I mean, actually the bank. And but my house, I mean, I have due, I mean, gains of value. I haven't paid off the dealer. Is there any way for me to refinance, or do I have to pay off?
No, if the equity is there, we can pay off the first and the second trust. Or if you got a pretty good interest rate on the first, and you want to try and do something with the second, we can just take care of that as well. So you have options. You don't, there's no term where you say you can't refinance it. You always can refinance it.
Okay, we can go on to investment properties.
Okay, let's do
Everyone's
that.
good?
Thank you,
Okay.
Jermaine. All right. So I think that even first-time homebuyers will benefit from hearing what we're going to talk about today, because when you buy your first home, sometimes you're thinking about the fact that you might not stay in it, and you're going to move someday, but you want to keep it as an investment and rent it out, which brings you back to my buyer's agents, who can help you when you say to them, I'm thinking about someday I'm going to rent this, I'm going to move out. And they're going to say, great, I'm going to give you some information about what that rental value is right now, and whether we think this is a good choice for you. This property may be an opportunity to do that, or maybe it's not. So it's important to follow along with this, even if you're a first-time home buyer. Investment properties, where do I start? Finding the properties. Financing is different for investment properties, whether they're a second home, like a vacation home. Some vacation homes have rental income, like at the beach, or it's a house that you will never occupy and you're just going to rent out. So you have different scenarios here. You're analyzing with your buyer's agent why you want to buy this house entirely different. I'll give you an example. On your primary residence, you might be tickled pink that there's a homeowners association and it's kind of high, but you get a swimming pool. On the rental property, I don't think you really want to pay for that swimming pool. So you're looking at it totally different. At the same time, and homeowners association for a rental property can be a beautiful thing because they're watching your property. They're looking to make sure the neighbors are keeping up their properties. They're helping you maintain your home and know that the value will continue to increase, which is why you bought that property. Financing is something that you'll have to discuss with your lender. Jermaine can help you understand that the rules for financing a property that is an investment property are far different. Normally, for example, you have to put more money down and the interest rates are slightly higher than you're used to seeing for a home-occupied principal residence. All right, maintaining, renting the property. These are both very expensive things. Once you decide what kind of property that you're interested in doing, you have to take into consideration, with the help of your buyer's agent and your home inspector, what is this going to cost you to maintain over this period of time? Oh, it's easy to see that the rent might cover the mortgage, but what about the roof? And what about repairs? And what about someone going there all the time to do things? And what if I move and I need to hire my agent to rent the property and they're going to charge a fee to do that? What's left? These are huge issues right now, and they're things that you have to take into account. They're formulas. Again, your agent can really help you with these things. All right, let's move on to the next slide. All right, we're going to help you with property records because people who are investors like to know what they can find out about properties. They want to be able to see information that's available to them, and real estate agents have a lot of information that they can look at through the MLS, the multiple listing. But you don't have that. And I know everybody these days with the internet wants to sit at home and stare at their computer and get their own idea of what properties are valued at, what the taxes are, what they're selling for. And I'm going to go through that real briefly with you just to give you an idea that this information is available. The MLS gets this information from these sources. I get my information from these sources. These are some of my secrets when you call me up and you say, Steve, who's living in that house? And I can tell you, and you're like, how did you know that? So let me tell you a little about that. All right, Maryland, let's focus on Maryland first. Each county in the state of Maryland, and most counties everywhere in the country, have a website that will give you tax information. You must be specific when searching Google or your search engine by putting in the county, the state, and then property tax search. Make sure you're doing that. That will allow you to pull up their website, and every time you're doing what I'm explaining, stay away from non-government websites. They're just there to throw you in another direction and try and make some money on you. I want you to stay at things that end in .gov and things that are obviously a county or government. The next one is state websites. For Maryland, we have the Department of Assessments and Taxation. Most states have this, but some states do not include real property. information. Maryland does. If you go to that domain or you simply Google Maryland Department of Assessments and Taxation, you'll be able to get in there and get all kinds of fabulous information using the property address about the taxes, the ownership, what they paid for it, how long they've owned it, maybe even mortgage information, how much they owe. But we're going to give you even more information about that by going to the next section, which is the Maryland Land Recs. Maryland has one of the best websites in the country for their documents, for deeds of trust, deeds, all the information, the real pages, and we're going to show you some of them, you can access for free on this website by going in. When you search a name in the right county, create an account, it's free, search by county, and then by property address or the name of the owner, and it's going to bring you up a tremendous amount of documents in chronological order about the deeds on the property, who owned the property, who owned it before, how much they paid, their mortgages, and you get an idea of how much money they owe. It really helps a sophisticated investor to know how much money they owe on their property. And as much as your real estate agents can help you do this, and they will do it, you can also do this on your own. Let's go to the next slide. All right, now the DC. DC's different. They have an SDAT website. It will give you owners' names, tax records, and legal descriptions. The trouble with DC is that when you want to see their documents, you're going to follow what I'm going to show you, and it's not free. And the good thing is, if you're not interested in printing documents, for free you can pretty much see what you're looking for. So let's go to the next one. This website you just saw will take us here. This is the tax and revenue. This is a standard site, and it's great because you can go in and put an address in there and find out what the taxes are, the neighborhood information, when it was built. Let's move on, it's pretty good. Fill in this information to move on and find bill payment. It'll tell you about the property taxes and whether they're paid. All right, now this is a website that we show the address for, and this is how you get to the District of Columbia documents, okay? Not just the tax records. And I want you to notice that some other states are on here, but not that many, because land records are not all published around the country. Maryland, I still say, is the best. Virginia, we're going to get to. And the way to get to the DC copies of land records is to go through this site, which the domain was in a previous page, and now you click on Washington, DC Recorder of Deeds, and it takes us to here. And it tells you to click through the next site every time. And now you can search public records. And this so far is free. So let's go to the next site. All right, now, do we know the name of the owner? What do we know? If we know the name of the owner or the legal description, we can pull up anything you see checked there. Deed, mortgage, the release of the mortgage, anything like that. If you don't want to see all that, you can just change those by clicking them out and just choosing maybe the deeds. Maybe that's all you want to see. All right, Virginia. Wow, Virginia, every county is like its own country in Virginia. It's amazing. And I point that out. Anybody buying properties in Virginia, I'll tell you, the transfer taxes and recordation, it's county by county. The calculations are bizarre. I don't know how each county ever came up with their numbers. And you can get all these figures from me. I will calculate for you all the closing costs, transfer recordation, anytime you want on any properties. Now, Virginia, you have to go county by putting in the name of the county, Virginia land records, and I use an example of Fairfax because Fairfax is pretty good. Your densely populated counties everywhere in the country are pretty good. Your properties, your counties without a lot of homes, particularly in Virginia, you'll get nothing. You might not even get a website. All right, let's move on. All right, this is an example of Virginia land records and deed directory, so that we can go to the next one, and you'll find this one by doing your search. I did the Fairfax one, and you simply click through general land record information. All right, we're going. You know, there's a lot of information on these, by the way. These counties have information about your school systems, demographics. These are the county sites. They take a lot of time and a lot of money to put this information in there. Your agents are there for you to do this too. They're masters at demographics. That's what they're there to teach you, but you can search some of this yourself. All right, determine type of sale, private, short, or foreclosure. All right, Those investors buying properties have opportunities to buy things that were foreclosed on, or short sales, or just in distress. So let's talk a little bit about what those are. Properties that were foreclosed on, the owner of the property didn't pay their mortgage, and the lender went through the full legal process of foreclosing on the property and taking it back. It's now owned in the name of the bank, all right? The short sale is not that way. The short sale is where the owner hasn't paid, and maybe foreclosure process began, but the lender is considering working with the owner to let them sell the house for less than the balance of the mortgage, including outstanding interest and penalties. Why do they do that? Well, it works, you know, I mean, they get more money sometimes than doing it in a foreclosure. However, there are different problems with each scenario. When you do a short sale, the lender is in control. The lender gets to decide how much they want for the property. When you make an offer, and your agents will help you with this, the homeowner would love to sign a contract, possibly for any number, to get out of this situation. It has to be approved by the lender. How long does that take? Forever sometimes. Investors have to be patient with these projects. They can take 9 months to a year. Sometimes they're less. They're rarely less than a couple of months, I can tell you that. So you're trying to buy a property this way as an investor. I think it's wonderful. I do these closings all the time. And I like them because when we get to foreclosure, we have a lot of legal problems, and these don't have those legal problems. You get the cooperation of the lender to make sure that I can clear title, that when you get the property, there's no issues about anybody out there that's still owed money. But you have to seriously be patient. All right, now, if you go through a property that's been foreclosed on, I want you to understand that if you're successful at getting a contract on the property and you're looking forward to going to closing, my job gets very difficult because chances are that property was foreclosed on within the last 3 years. If it was foreclosed on within the last 3 years, I cannot simply say that the foreclosure was done right. I cannot simply say that everything that happened before the foreclosure was resolved. I have to do a full title search, and I have to look at it as if there could be liens and judgments, unpaid debts, and unpaid mortgages from way back in time until the day we're going to do the closing. And that is a complex search, particularly when you're talking about an owner that defaulted because they probably didn't pay a lot of their bills. They probably went through bankruptcy. Now I have to look at their bankruptcy papers. I have to see whether any debts got discharged or not. It's very complicated, and that's another level of being patient. And on top of that, it might not work. You might end up working on a property for a while, and I can't clear that title, or it's just going to have to be extended for a while, okay? So it takes a lot of patience, and the savvy investors know that, and I don't discourage you from doing it, but I just want you to understand you're getting into something that's complicated, all right? When it comes to, by the way, negotiation on properties that are short sales and foreclosed, good luck. These banks won't even talk to you. They don't come to closing. They don't really care the condition of the property. There is an as-is rider on every deal. And that means that you buy it as is. You're not just the consumer, but you're the investor, and you're knowledgeable. And if you get a home inspection, which I think you should, that just educates you about what you're buying. It's not a way to negotiate with the seller as it would be in a normal transaction. You get a home inspection, you see something that was a real big problem, and you didn't know about it, your agent will probably help you in talking to the seller about negotiating. Okay, so we have definitely lost connection with the rest of the world. All right, so is there a fire?
The projector just popped.
Okay, so it's just a projector.
Yeah.
All right, okay. So let's just go on a little more, all right? All right, so that's an important thing to differentiate. You're not going to really negotiate. And I've seen severe cases where terrible things were found in inspections, and the lender just went, I don't really care. And they don't. They just don't. All right, I'm going to go off of my sheet that I have here. Oh, and I want to tell everybody in here that's considering buying a property that's occupied. The District of Columbia has something called TOPA. Those are Tenant Opportunity Protection Act. These are tenants' rights. They are super powerful. Here's the idea. It was a great plan when it started with like a lot of government programs. They said, you know, you have tenants living in these 1, 2, 3, 4 unit buildings, and the owner wants to sell it. Don't you think the tenant should have the opportunity to buy it for the same price? Great idea. Problem is, it gets complicated. The owner dies, he has heirs, there's co-owners, maybe he was selling it to his brother. Is that really like a regular sale? What if the tenants can qualify, what if they can't qualify? The thing got really, really complicated, and it remains complicated. And so if you're looking at an investment property and there's tenants renting in there, TOPA rights are critical. I cannot insure the transaction. When I issue title insurance, I'm guaranteeing that all of the property rights become yours and the new bank. TOPA rights are property rights. Everything we've talked about is a property right. I have to make sure that when I deed it, a tenant can't come back and say, I wasn't given my notice. I didn't know it was being sold. I wasn't given an opportunity to buy it. I could have bought it. That is a claim on my title insurance policy. So you got to be really careful. Baltimore City. At this point, I have to tell you, I've considered not even doing business in Baltimore City because it's complicated. Baltimore does have a program that's comparable to TOPA. Not as difficult to get through, I will tell you that. But Baltimore City properties and the District of Columbia properties for investors have a lot of landmines. If you buy a property in those jurisdictions, the cities are very, very happy to assess special liens against your property for things you would never dream of. A sidewalk lien, tall grass lien, abandonment lien. It's incredible, and these numbers are huge. We had a property where it was being rehabbed. Beautiful property, turned in DC from 1 unit to 6, ended up selling for millions of dollars. Each unit was $750 a piece. But during that time, the city said, well, you know, that thing's vacant. We're gonna make the taxes, instead of $1,500 every 6 months, $9,000 every 6 months. And so during development for 3 years, it was $9 grand per 6 months for 3 years. And you do the math. That'll take all your profit out of the deal. So you gotta be careful. You gotta always be watching the land records. You know, this information can allow you to see these things, and I'm always available to give you guidance for these things. All right.
Financing?
I'm sorry?
What, the financing? Financing?
Well, we talked a little about the financing and how it's different for investment properties. And what I'd like to talk to you about now is putting your properties into either an LLC or a trust. And I know people want to hear this even if they're not investors. So I'm going to start as if you're not. I deal now more with trust than I ever have in my practice since the early 90s. And the reason is because 2 reasons. Lenders now lend money to trusts. They're okay with it. If a property is purchased from someone and deeded right into the Smith Family Trust, Germain can make you a loan to buy it. So that creates an opportunity for you to use a trust. And you might want to use a trust because it gives you great features. If you remember, we talked about tenants in common. If someone passes away, the property has to go through probate, and there can be claims. If your property's in a trust, it doesn't have to do that. That's a great protection. If your property, if you own a property and you have a will, when you pass away, your property has to go through probate in certain jurisdictions. But a trust replaces a will and prevents it from having to go through probate. And it's a better will. I'm going to tell you why. Wills are pretty simple. I think everyone's probably seen one. You know, I bequeath this property to my 2 kids, and they can split it, or it gets sold, and the value, the proceeds go to these 3 children. A trust can design an infinite number of changes over the terms of their children or their family. They can say that the property remains in the trust after I die for 40 years, and it's going to be rented, and the money is going to be dispersed this way and that way, and my underage child doesn't get any money until he's 21, and he gets a certain amount when he's 25, and this just goes on, and I've seen 200-page trusts. It allows you to do whatever you want, and it's a super powerful tool, and people like it. But I want to emphasize that it does not have the protection of the judgments we discussed earlier not becoming liens unless you purchase the property as tenants by the entirety, because that has the protection, and then you deed the property to the trust from the tenants by the entirety to the marital trust. So these are things this is why you need the guidance of an attorney, and I will refer you to someone that can help you with these things. And we said earlier, everyone's scenario and everyone's story is different. It is. So that's why you meet with someone and you decide, well, is this going to work for me or not? I've had people that have put their properties into a trust and then transferred to an LLC. Why do they do that? LLCs are notorious for protecting people against lawsuits, because what they do is everything that you put in your LLC, and let's say you just put one property in it, and you have 30 tenants, and you own it for 30 years, there's a good chance something's going to happen. So there's a slip and fall and they sue you. Well, that means that judgment can only be as much and take from you as is owned by that LLC. You personally are not liable. But I don't recommend that for every property you buy, because most properties that you buy as an investor, you're probably going to decide, well, I'm going to rehab it and flip it in a year or two. I'll put it either in my name with my wife, or in my partner that's doing it with me, or into a trust. The LLCs are really there for situations where it's predictable that you're going to end up with a lawsuit, like my example of multiple units and keeping it for a long term. And one other reason you don't want to do it is because now you're going to get into what lenders will lend you money to an LLC, and that changes the game again. So you may not get the loan you want if you originally purchased it in an LLC. You're back to talking to your lender about advice and talking to them about what you're trying to accomplish, okay? So every scenario you need to present to your buyer's agent, you need to present it to your closing attorney, you need to present it to your lender and say, what's gonna work? This is what I'm thinking about doing. What's the best scenario? And that's your team, okay? That's your team to help you figure it out. All right, let's see. Do I have any, can I go through any questions? Because I usually get questions about trusts, LLCs. Anybody have any? Oh, wow, that's great. All right. Does anybody have any more questions at all about, for any of us that have talked today? No, we're good. Do you have anything else?
No, I think we're good.
All right, listen, I really want to thank everyone that came today and everyone on Facebook, but I also want to thank Lafayette Federal Credit Union and Maryland. You did a phenomenal job putting this together. This was a tremendous amount of work, and it took a lot of experience, and she had it, and she put this together, and I'm grateful, and Jermaine is too, and I'm glad you all could come today. Thank you very much.